We'll start today by laying a foundation, introducing core accounting principles that serve as the bedrock for everything that follows. Accounting is often called the language of business, and by the end of this chapter, you'll start to see why. These basics are not only essential, they're also fascinating in how they shape the way we see businesses. Here we introduce some necessary accounting theory. In the USA, it's known as Generally Accepted Accounting Principles, or GAAP, and internationally it's known as International Financial Reporting Standards, or IFRS. Accordingly, anywhere in the world, we have the forthcoming accounting theory issues. We will take them one at a time. The historical cost principle, the lower of cost or market principle, the matching principle, the use of estimates and contra accounts. With the historical cost principle, no adjustments are made to assets to reflect fluctuations in the market value or changes resulting from inflationary fluctuations. We say that historical cost is the only objective, verifiable evidence of value. We sacrifice relevance for objectivity. Historical cost is objective, but it may not be relevant. However, we do not want accountants to be in the business of valuing real estate each accounting period. 5 times cost may be the relevant value, but it is not objective, and we do not sacrifice objectivity for relevance. So let us take, for example, the Woolworth building in New York. When completed in 1913, it cost $13.2 million. Today, that same building would be estimated at $600 million. That's $30 million for one condo in the building. What is the significance of the historical cost principle? In companies all over the world, a given company might own real estate that has a current market value many times the original cost, less depreciation. More on Woolworth, the USA former retailer. It had 800 stores on Main Street and in every significant town in America, with values recorded at less than $25,000 per store. The market value for each store was, on average, $4 million for 800 stores. In addition, it had a headquarters building in New York City, a 60-story building that was the finest example of Art Deco architecture in the world. It was on the books for $7 million. When the company shut down its operations, the stores were sold for, on average, $4 million per store, times 800, or $3.2 billion. And the headquarters building sold for $600 million. Investors that did an analysis on the real estate and bought stock in Woolworth when it closed its stores bought the stock for next to nothing. To the unsophisticated investor, Woolworth was a money-losing retailer, worth next to nothing. However, to the investor who understood the historical cost principle, its real estate was undervalued by almost $3 billion. FYI, investing in Woolworth was what we call a 10-bagger. We made 10 times our investment in the company. Gotta love that historical cost principle. The lower of cost, or market principle, states that in the name of conservatism, we value inventory at the lower of cost or market. As an example, a computer manufacturer may have component parts that have lost significant value due to obsolescence. It could be that a new motherboard is faster and cheaper than last year's item. Lower of cost or market dictates that the company lower the value of its motherboard inventory. The matching principle, along with the historical cost principle, represent the two most important accounting theory applications. The impact of the matching principle in accounting is enormous. It states, revenue is recognized as earned and expenses are recognized as incurred, regardless of the timing of cash flows. We call this method of accounting accrual-based accounting. By recording revenue as earned and expenses as incurred, we can arrive at a true value for profit or loss. It differs from cash basis books, which record revenue when cash is received and expenses when cash is paid. Many small companies report on a cash basis, but if you are a business that sells merchandise, accrual basis books are required. Reporting revenue when cash is received and expenses when cash is paid does not yield a statement that accurately records revenue and expense. As a consequence, it does not yield a relevant value for profit and loss. There are people running their own businesses who do not understand the matching principle, and as such, do not have accurate books. We developed this course because over our 40-year period of business consulting, we have seen damage done to a business where the owner did not understand accrual basis accounting. In accrual-based accounting, we have timing differences, as we discussed in this section on accounting theory. Those timing differences sometimes give rise to what we call valuation accounts, or contra accounts, as they are sometimes called. They involve estimates, as we shall see. Let us now look at some examples. In our opinion, there is a real urgency in learning about what we call timing differences. Here, we illustrate 6 possibilities. In our schematic, we have the active period. It is March. We can have an active period for a month, a quarter, or a year. Here we are doing the books for the month of March on the accrual basis. By definition, February is the prior month, and April is the month after the active period. Cash flow in or out can happen before the active period, during the active period of March, and after the active period, April. Item number 1, a retail sale is made and the cash is collected in March, the same period as the sale. In this case, cash is received in the same period as the sale. Item number 2, equipment is leased in March and paid for in March. Here, cash outflow and equipment purchase happen in the same month. Item number 3, we receive cash in February for a subscription service to be delivered beginning in March. Since we have not earned the February payment, we record the cash receipt in February as unearned revenue, a liability. It's as if we borrowed money from a customer. In March, when we have earned the subscription revenue, we debit unearned revenue, a decrease, and credit subscription revenue, a revenue account, an increase. Item number 4, we prepaid a March expense in February, resulting in a cash outflow in February. Since the advertisement will not run until March, cash outflow precedes the expense. We record a prepaid expense, which is an asset, not an expense. We have a store of value in February, the prepaid expense. In March, the expense is incurred. We debit the expense and credit prepaid expense. No cash in March. Item number 5, a sale on account in March where cash is not received until April. The revenue is earned in March, so the sale is recognized in March. Since we did not receive payment, we record accounts receivable in March, an asset. In April, when the cash is received, we debit cash and credit accounts receivable. Revenue is recognized in March. Cash inflow in April. Item number 6, we incurred an expense in March that we did not pay until April. The expense was incurred in March, so we record it as such, and credit accrued expense, a liability. In April, we pay the cash, credit cash, and debit accrued expense. To summarize, in all 6 cases, revenue was recognized in March, and all expenses were recognized in March, whereas cash flows occurred during March, before March, and after March. The salient issue was recognizing revenue as earned and expenses recognized as incurred. These 4 journal entries illustrate timing differences. In JE5, we have sales with no receipt of cash. We record an account receivable. In JE10, we receive cash that is not earned, resulting in recording a liability, unearned revenue. We have not seen JE17 and JE18. They are yet to be introduced in our section on journal entries. In JE17, we record an expense for marketing that is not paid for, resulting in an accrued expense credit, which is a liability. In JE18, we prepay an expense, cash outflow, but the expense is not yet incurred.